Some startup companies and growth stocks are having a tough time finding the cash they need to keep growing, which means some of them are going on sale. Do you know how to find a good one to invest in? What's up everybody, I am Jaspreet Singh and welcome to the Minority Mindset. The 2010 to the 2020 decade was the decade of the startup. Shark Tank became one of the most popular shows on TV. Money was cheap and easy to access for young startups, and companies were getting sky-high valuations, which helped founders and investors get rich, or at least feel rich. Now it looks like the startup boom is really starting to slow down. While the stock market has been very emotional, up and down, the economy has been hurting. And this is not good news for startup companies and growth companies because it's becoming harder for them to access more cash because their investment companies where they get their cash from are being more picky with how they invest their money. That means they can't get the cash they need to keep growing and running the way they were. Just look at the numbers. I mean, over just the last few weeks, Limebike laid off 13% of their employees. Vice Media is firing employees left and right. Airbnb is laying off thousands of people. And Uber and Lyft are both laying off thousands of employees just so they can stop burning so much cash to keep their companies alive. If you've been subscribed to our channel, this shouldn't come as a huge surprise because about 6 months ago, I released a video where I talked about this startup dilemma that was going on, where all these startup and growth companies were getting sky-high valuations with revenues, costs, and profits that weren't making too much sense. So I said that you need to be very cautious when you invest in these companies to really understand what's going on. If you haven't seen that video yet, I'll link it for you in the description below. And while you're there, you might as well hit that subscribe button and that thumbs up button too. Back then, some things just weren't making sense because of the valuations that companies were getting based off of their certain revenues and expenses and profits. But it didn't need to make sense. The money was there. But now that the economy slowed down, it is harder for these startups and growth companies to find that easy money. So now they're being forced to downsize and find a way to be cash flow positive to try to stay alive. When I say easy money, what I mean is the owner of a company, the entrepreneur, the founder, they can go raise money by selling equity or ownership in their company. And venture capital firms just had so much cash that they were looking to invest that the owners of companies were now realizing that, oh, I can make so much more money by just trying to raise more money. This way I can get a higher valuation for my company than actually selling my product. So companies were being incentivized not to make a profit, but to just get a higher valuation. The whole thought process behind this is don't worry about making a profit today. We'll just keep feeding you money as your investor, and you just keep focusing on getting more clients, getting more users, getting more subscribers. And that way you can make a much bigger profit in the future, no matter how much this cost is to get new users. The concept actually makes a lot of sense. But what we've seen happen time and time again throughout history is people take a good thing and then they abuse it and it turns into too much of a good thing. Take a look at what I mean. So Doordash, the meal delivery app, had a lot of investment cash in their bank account. And if they wanted to raise more money, they need to show their investors that they are getting more users, even if that means paying $2 to get a user that's only worth $1. Well, this became big news recently because a local pizzeria found out about this and they used it as a way to make them money. A local pizzeria was charging $24 for a pizza. But then Doordash wanted to get new customers, so they started marketing this exact same pizza to their customers on their app for $16. So you would go on your app, buy this pizza from Doordash for $16, then Doordash would take your $16, walk into the pizzeria, give them your $16, and then give them another $8 out of their own pocket, buy this pizza, and then deliver it to the customer. That means for each pizza sold on Doordash, Doordash would lose $8 to cover the cost of the pizza and then would have to pay for the time and fees of the employee to do the job. Well, the pizzeria saw this and they were like, wait, we can go on the Doordash app and pay them $16 for a pizza and then they're gonna come into our store and give us $24? Yeah, can you make that an extra large, please? So this pizzeria went on their phone, they downloaded Doordash, and they started buying their own pizzas for $16 because every time they gave Doordash $16, Doordash would give them $24. It was pizza arbitrage. I mean, if you could make $8 for every pizza that you bought, and maybe add some extra guac too, how many pizzas would you buy? Exactly. Now, at this point, you're going to have one or two thoughts. If you're a big investor, you might be thinking, well, that's the cost of getting a customer. It's the customer acquisition fee. And the other thought process is, wow, how can they afford to just lose so much money? Well, Doordash was getting their money not from their own profits, but from their venture capitalist. And here, their investor in this case was Softbank. And I talked about Softbank in that video that I talked about earlier, and I got it for you in the description below. Well, what Softbank was doing was they were encouraging their companies to invest a ton of money into growth at whatever cost it took, because money was essentially free. So DoorDash took advantage of this by investing heavily into customer acquisition without really worrying about the cost of it. And the local pizzeria took advantage of it because they saw this as an opportunity to make money buying their own pizza. But remember, too much of a good thing can be a bad thing. The thing that SoftBank and other investment firms didn't calculate very well is what would happen if the economy slows down and this easy money isn't as easy to access anymore. I mean, everybody thinks that when things are going up, it's just gonna continue going up. Well, SoftBank was making so much money, at least on paper, because these companies were getting crazy high valuations, even though none of them were actually making money, but they looked like they were making money on paper. But then when the economy started to slow down, reality started to hit, and then SoftBank realized that, wow, this isn't working the way we thought. SoftBank ended up going into crisis mode because they started seeing losses like they have never seen before, because their investments like Doordash and Wework were bleeding money. It's funny, no one ever expects things to go wrong when times are good. Before I get into what this means for you, if you are interested in staying up to date on what's happening in the top finance and business news like this, well, that's why we created our free Minority Mindset newsletter, where our team first breaks down the top finance and business news, and then we show you how this news affects your wallet. That way you can be smart with your money. This newsletter is completely free, and you can subscribe to our free finance and business newsletter by clicking the link up here or by clicking the link in the description below. By the way, our financial news emails are different from our financial education emails. Don't get me wrong, I'm an entrepreneur myself. I love entrepreneurship. I love the startup scene. But sometimes things don't make sense. However, if you are investing in these growth companies, this also means that you might be able to invest in some of these growth and startup companies at a big discount. That being said, let me also remind you that investing has risks. You are never guaranteed to make money when you invest. You might even lose money when you invest. So you should always do your own due diligence and don't just blindly listen to a random guy on YouTube. Here's the thing, it's not completely unreasonable for a startup or a growth company not to make a profit, because they want to invest every dollar that they have back into their business to get more users and more customers. What you want to pay attention to is their path to profitability, their CEO, and their product. If a startup or growth company is public, meaning they trade on the stock market, they will openly state to the public when they think they will be profitable. And if they say something like, well, we don't know what our path to profitability is, and we don't know when we'll be profitable, that's a big red flag. This is exactly what Wework said before they went public, and at the time, they were valued right around $50 billion. To put that in perspective, that's a little bit less than what GE was valued at, and Wework owned no assets. Well, after Wework said that they have no idea when or if they'll be profitable, they also said that they were burning cash at an insane rate, and they were expecting to run out of cash in a few months. By that time, investors got fed up, and they said that they did not want to invest in Wework, so the Wework valuation fell from just under $50 billion to under $10 billion. So look at a company's financials. If they're a public company, this is all going to be public knowledge. Look at how much revenue they're making and look at what their expenses are. If their expenses are growing a lot faster than the revenues, that's another red flag. The second thing you want to make sure you look at is who's running the company. If a company is public, you will be very surprised to see how much you can learn about the CEO if you just do a couple of Google searches. Look at how passionate the CEO is about their company and about making a change. Elon Musk, for example, literally lives for his company. Like, he breathes Tesla. Although Tesla might have other issues with the company, nobody can say that Elon Musk is not a passionate CEO that cares and will do everything he can to make the company successful. Now, this isn't the only thing you want to look at, but this is something you definitely want to factor in. Other times you'll see more establishment type CEOs that are not really passionate about their particular product. It's more of just them trying to drive more sales. So this is something you want to consider. And third is the product itself. How important is this product today and how important will it be in the future? Oh, and how easy is it for other companies to compete with them? You can take a look at a company like Casper Mattresses, for an example. Casper Mattress Company essentially just lets you buy a mattress on their website. They're gonna get this mattress made and then they're gonna ship this mattress to your house. Not much going on there. They're essentially just a glorified dropshipping company. I mean, if you have a few $1,000s saved up, you can start your own mattress company. That's not something I want to see as an investor. If I'm investing my money in you, I want to know why somebody else can't just come in and take your spot. Do you have some sort of market share that's hard to grab? Do you have some sort of product that other people can't compete with? Do you have a name that people love? What is it that makes you so special? Then you want to take these 3 pieces of information and then balance them against each other and make an investment decision based on all 3, not just one of them. Again, investing in growth companies comes with more risk because if they can't raise the cash to keep going, or if they don't get bought out, then they could be facing bankruptcy if they run out of money. But this risk also comes with more opportunity for you as an investor, meaning you could make more money. You could think of it kind of like trying to invest in Amazon before they are what they are today, and investing in Starbucks before they were on every street. During times like this, lots of opportunities are gonna come our way, but you need to make sure you understand the risk and need to make sure that you do your own due diligence, do your research. Thank you for watching. If you enjoyed this video, share it with one friend, that way we can help spread the word. If you want to learn more about dividend-paying companies slashing their dividends and why this can be an opportunity for you, I already made a video on it and you can watch this video on YouTube by clicking this button right over here. Thank you for watching and as always, keep hustling.